Hey everyone, Andy here. I wanted to do a quick video about required minimum distributions, or RMDs. Specifically, I'll be talking about RMDs that you have to take from your own accounts, not accounts that you inherited from someone else. I'll touch on those in a different video. I got a question recently in my Facebook group about actually how early in the year I have to take an RMD. How early in that year can I take that RMD? Do I need to actually wait until I'm a certain age? And the answer is no. So that got me thinking, let me just elaborate and explain how early in the year you can take it, or how late. And then while I'm on it, might as well talk about some of the other things to consider and know about RMDs. So first, what is an RMD, or required minimum distribution? Well, think about when you have a tax-deferred retirement account, like a traditional IRA, like a 401k at your employer, a 403b at your employer, whatever it may be. You don't have to pay tax on the money you put in. That's the whole benefit of these plans. The money you put in gets you a deduction, if you will, from your income in that year. But you're not getting rid of tax, you're simply just deferring the tax. You have to pay it eventually. Well, what an RMD is Uncle Sam saying, okay, you've kicked the tax can down the road long enough. We're gonna force you to start taking some of this money out and paying tax on it now. You can't defer the inevitable tax forever. Specifically under current legislation, in the year you turn 72, that's the first year in which you have to start taking money out of your tax deferred accounts, subject to a few exceptions, which I'll touch on in a bit. So the way it works is, in the year you turn 72, you have to take out, as I mentioned, a minimum amount, a required minimum distribution from your tax deferred accounts. That amount is based on the December 31st balance of your accounts from the year prior. So this year, for example, in 2022, let's assume you turn 72 this year in 2022, you would look at your December 31st, 2021 tax deferred account balance and divide it by a specific factor. Now these factors come from something called the Uniform Lifetime Table, which I have a summary of on my website. You can see a link in the notes to this video to go get that free summary. You don't have to put in your email or name or anything, just click on it, download it, there it is. It'll give you the factor. In the year you turn 72, that factor is 27.4. So basically you would take your December 31st, 2021 account balance, divided by 27.4. That's the dollar amount of required minimum distribution you need to take for 2022. Now, the original question again was, how early in the year can I take that? You can take that amount any point during 2022. Even if you don't turn 72 until June, July, December 31st even, doesn't matter. It's the year you turn 72 is the year you need to take it. And you can take that RMD distribution at any point during that year. You do not need to actually be 72 to take it. So that's the soonest you can take it. January 1st of the year you turn 72, to answer the question, is the soonest you can take your RMD that year. Now, how late can you take it? The first year's RMD actually has an exception. Typically, you would have to take it by December 31st, but the first year's RMD and the first year only, you can actually further delay into the following year. Specifically, you can take it up until April 1st of the following year. You can take your first year's RMD. Sounds good, but again, you're still just further deferring and delaying the inevitable. If you do take your first year's RMD, or actually you do additionally delay your first year's RMD into the beginning of the next year, well, then you're actually gonna have two RMDs to take that year. You're gonna have to take the one you deferred over from your first year, and you're going to have to take the second year's RMDs. So now you may be stacking yourself with a lot of taxable income in that second year, which may not help. So you may have been better off just taking your first year's RMD in the first year you're supposed to, 2022 in the example I was using, as opposed to further deferring it until 2023, because then in 2023 you'll have two RMDs to take. And yes, there are RMDs. There are RMDs every year for the rest of your life, starting the year 72. Again, every year. So in the year 73, what you'll do is you'll look at your December end balances from the prior year, divided by the factor for age 73 from that Uniform Lifetime Table. And same process when you're 74, 75, and on and on and on. So that's RMDs in a nutshell. They apply to all tax deferred accounts you have. Like I said, traditional IRAs, 401ks, 403b, 457, Federal Thrift Savings Plan, etc. If you have Roth IRAs, you do not have to take RMDs from your own Roth IRAs. If you inherit one, different story. As I said, that's outside the scope of this video. But your own Roth IRAs, you do not need to take RMDs from. If you have a Roth employer plan, like a Roth 401k, you do need to take RMDs from that. Now, the money won't be taxable because it's Roth money, assuming you meet a few qualifying conditions, which generally people do, again, outside the scope of this video. But you nonetheless need to take money out of your Roth IRA, Roth 401k, starting in the year you turn 72. Now, one way around that is you can roll your Roth 401k into a Roth IRA. Once it's in the Roth IRA, as I mentioned before, there are not RMDs from your own Roth IRAs during your lifetime. Another thing to keep in mind is that you can mix and match your RMDs across different IRAs. So for example, let's assume you have 5 different IRAs for whatever reason. The IRS looks at all of your IRAs in essence as one big fat IRA. So you'd have to look at the aggregated balances across all your IRAs as of the prior December 31st, divide that by that year's relevant distribution factor from the Uniform Lifetime Table, and that's the total amount of required minimum distribution you have to take. Now you can choose to take that amount from just one of your 5 IRAs or spread it across the 5. It doesn't matter. So long as the total amount that comes out of one or multiple of your IRAs is at least as large as that aggregate RMD amount from the combined IRAs, that's all you have to do in the eyes of the IRS. Now it's different if you have employer plans. You can aggregate RMDs across IRAs. You can't cross over and take an IRA RMD from your 401k and vice versa. For each 401k you have, whether it's 1 or 10, you'll have to calculate each 401k's IRA, and you will have to take each 401k's RMD, a lot of acronyms here, and take that 401k's RMD from that account. If you have another 401k, you have to take that 401k's RMD from that account. So these can't be commingled, nor can they be crossed over and mixed and matched with IRAs. Another wrinkle here is annuities. If you have an annuity that's what's called annuitized, meaning you irrevocably handed over money to an insurance company, it's now producing for you a guaranteed lifetime stream of income, that annuity's income is deemed to satisfy that annuity's RMD. You don't have to take any more or less out of that annuity. That is ring-fenced and separate from your IRAs, from your 401ks, whatever. So for RMD purposes, if you do have an annuitized annuity, basically carve it out and forget about it. Just look at the balances of the rest of your tax-deferred accounts, IRAs, 401ks, 403bs, etc. Another thing to keep in mind is if you are still working and you have an employer plan like a 401k, you can potentially delay taking RMDs from just that account while you're still working, even if you are 72 or older. So long as you don't own more than 5% of the company, and if your employer plan allows it, you can delay taking RMDs from that plan while you're still working there. For example, let's assume you have 2 IRAs, you have a 401k from the place you're still working, and you have an old 401k from the job you left 10 years ago, let's say, and you're 72. If you don't own more than 5% of the company whose 401k, the company you're still working at, and if the plan allows it, you can delay taking RMDs from that 401k until you eventually stop working, retire, or whatever. You'll still need to take RMDs from your IRAs. You'll still need to take RMDs from the other 401k from the old employer. You can only delay the plan from the employer at which you're still working. So that's a nice little trick if you're 72 or older and still working. For some people that doesn't apply, but if it applies to you, great. It's one way to further delay RMDs. One other thing I want to touch on quickly is if you are wanting to do Roth conversions, like taking money or securities from your traditional IRA and convert them to your Roth IRA, and you are of RMD age, conversions cannot take the place of RMDs. So let's just assume you have a $50,000 required minimum distribution for the year. You need to actually distribute out $50,000 of cash or securities from your IRA into your bank account or your brokerage account, whatever. You can't put that $50,000 into your Roth IRA, meaning you can't quote unquote convert it to your Roth IRA. It has to come out of your IRA and not go into your Roth IRA. Separately, if you want to do conversions on top of that, you can. You can do another $50,000, for example, conversion from your traditional IRA into your Roth IRA. But that conversion cannot take the place of the RMD. The RMD needs to come out first. Only then can conversions happen. So maybe it makes sense, maybe it doesn't. It depends how large your RMD is, how much other income you have. Converting on top of it, maybe giving yourself more income than you want or need, so that may not make sense for you, but just know that conversions cannot take the place of RMDs. What can take the place of RMDs are QCDs, or qualified charitable distributions. These are when you, from an IRA, you can donate money directly from the IRA to a qualified charity. That's called a QCD, Qualified Charitable Distribution. That can take the place of RMDs. So if you have a $50,000 RMD requirement for the year, but you don't actually need that money to live on, and you're charitably inclined, well, you can donate 50 grand straight away from your IRA to a qualified charity. That does take the place of your RMD. You will not need to take additional monies out, and that donation is not taxable. So 50,000 leaves your IRA, goes to the charity. It doesn't show up as part of your gross income on your tax return, so you're not taxed on it. Neither is the charity, and it wipes away your RMD, which is a win for everyone if you're charitably inclined. So that's it. Hope you found this helpful. That's my quick summary about RMDs. If you like it, please definitely like this video, subscribe to this channel, and check out the links in the notes here. You can find other sources of good info like my Facebook group, my newsletter, my podcast. That's it. Take care.